Last week we did a video on advanced strategy for mutual fund investing. The link for the video has been provided in the description box. But for beginners, that video might be a little bit confusing. So this video is dedicated to people who don't know much about mutual funds, may have never invested in them, but are considering to start investing in mutual funds. In this video, we will be discussing what exactly is a mutual fund, who is it for, how it can benefit you, the brief history of mutual funds in India, few important terms to understand before you start investing in mutual funds, comparison of investing in mutual funds versus directly investing into stocks, various types of mutual funds available in India, and finally, the risk associated with mutual fund investing. Namaste and welcome to Retail Investing. So what exactly is a mutual fund? Let's say there is a garden with hundreds of exotic fruits which are very expensive and are also large in size. Suppose as a buyer, I am not at all interested in paying that much money for just one fruit. So what the garden authorities decide to do is cut those expensive fruits into small pieces and sell them as small servings of a mixed fruit salad. That way, as a customer, I have to pay only a small amount of money and taste all those exotic fruits in a small plate. Also, for the garden authorities, it will be a lot easier to find a lot of customers like me. In case of mutual funds, the individual stocks are like the exotic fruits. For example, a single MRF share is worth 98,000 rupees, and the small servings of the mixed fruit salad are the units of a mutual fund which customers like you and me can buy for as low as 500 rupees. That's a win-win situation for both sides. It could be for anybody, but for the salaried class, mutual funds could be one of the best investment options available. Salaried people usually don't have huge capitals at their disposal. For them, mutual funds can be an effective tool for long-term wealth creation with monthly investments of only 5,000 rupees. The first benefit is the option of starting small. People can start investing into a mutual fund with as low as 500 rupees. Secondly, the fees paid to the professionals who manage the mutual funds are quite small. Let's have a look at a very popular mutual fund by the name of Mirae Asset Large Cap Fund. If you invest 5,000 rupees in this fund, you will have to pay only 25 rupees as fees. If you compare that to the fees required to invest in a small case, the difference is unbelievably huge. There are some small cases which require you to pay 15,000 rupees as fee for a few months. You will have to pay 15,000 rupees again after a few months. And for buying the stocks recommended by that small case, you might require a minimum of 75,000 rupees. I am never doing that. And thirdly, some mutual funds can also help you save taxes, like the ELSS funds. The first mutual fund in India was the Unit Trust of India, and it was launched in 1963 by the Parliament. It was a government mutual fund. In 1987, the first public sector mutual fund of India, which is the SBI Mutual Fund, was launched by the public sector banks and the LIC. In 1992, after the Harshad Mehta scam, SEBI came into existence to protect the interests of investors. And after that, the first fully private mutual fund was launched in 1993. This was the beginning of a new era for mutual funds in India. The period from 2003 to 2008 saw a massive bull market and investors were minting money. Then came the global financial crisis of 2008. Investors lost most of their gains of the last 5 years. After this, retail investors lost interest in mutual funds. Post 2014, SEBI took a lot of steps to increase the popularity of mutual funds, especially in Tier 2 and Tier 3 cities of India. Since then, the mutual fund industry has experienced steady growth. Mutual fund distributors have played a crucial role behind this growth. Now let's understand a few important terms before we start investing into mutual funds. Do you remember the exotic fruits and the mixed fruit salad we talked about? The AUM is the total amount of fruits available in that garden. In finance terms, it is the market value of all the investments that the mutual fund has under its control. It is directly related to stock market fluctuations. AUM is a crucial indicator of the performance of a fund. Also, higher AUM means more liquidity, which would make it easier to buy or sell. If AUM is the total amount of fruits available and unit is the size of one plate of your mixed fruit salad. So in a mutual fund, investors don't buy stocks, but units which are made up of many stocks. The NAV of a mutual fund is calculated by dividing the assets under management by the total number of outstanding units. So if the NAV is low, you will get more units of the mutual fund at the same price. NAV does not decide the quality of a mutual fund. It is the amount of fee that you are paying to the mutual fund for managing your money. It is denoted in percentage. So if a mutual fund has an expense ratio of 1%, it means if you invest 1 lakh rupees annually, the mutual fund will keep 1% for itself and invest the remaining 99,000 rupees into stocks and bonds. A mutual fund house is made up of a big team of professionals. The team includes management, research analysts, accountancy experts, legal experts, salespersons, marketing professionals, and so on. All these require a lot of operating expenses. The total expense ratio is a measure of the total costs of running a scheme. By comparing the total expense ratio of various schemes, investors can get an idea of the cost effectiveness of these schemes. Total expense ratio includes management fees, brokerage fees, taxes, legal and accountancy fees. Exit load is charged on investors if they sell units before a specified period of time. For example, the Parag Parikh FlexiCap fund has an exit load of 2% if the units are sold before 365 days. So you need to check this well before investing and decide your time horizons. New fund offer is a way for a mutual fund house to raise money from the public to invest into stocks or debt instruments. Investors won't have any data regarding past performance of this fund. It's like an IPO. To me, investing into an NFO is like starting a business with someone as a business partner whom I have never met before. I don't want to do that. For beginners, buying stocks directly from the market could be very risky. Most new investors lose money in the stock market for various reasons. It could be because of buying stocks based on news or rumors. It could be because of buying good stocks at the wrong time and for the wrong price. Let's take the example of Tata Motors. The Tata Motors stock gave almost no returns for 18 years. The stock was trading at around 20 rupees in 1991 and 18 years later in 2009, it was trading at around 30 rupees. But when mutual funds decided to invest into the stock went 10x in no time and touched an all-time high of 600 plus. In case of buying stocks directly from the market, you may have to pay a lot of fees and taxes if you decide to sell old stocks in your portfolio and replace them with new ones. In case of mutual funds, you can avoid this altogether. Paying fees and taxes too often is not beneficial for compounding your wealth. Some mutual funds, like the ELSS fund, can help us save income tax. Mutual funds can be classified into dozens of categories with fancy names. To study them all would be a complete waste of time. For successful investing and long-term wealth creation, only 3 to 5 mutual funds from around 3 categories are enough in my opinion. The first classification that we need to do is the classification based on asset classes into which the mutual fund decides to invest. They are equity funds, debt funds, and a mixture of both, called hybrid funds. The first category is equity funds. These funds put most of their assets under management into stocks of companies. As we all know, stocks go up and down randomly in the short term, but in the long term, they create the most amount of wealth. Among equity funds, there are large cap, mid cap, and small cap funds. This classification totally depends on the size of the companies in which a mutual fund decides to invest in. Good large caps can consistently compound your wealth with less volatility. Small caps tend to be the most volatile and they can make new investors panic and sell out at the wrong time. There are also flexi-cap funds which invest into all 3 categories, that is large cap, mid cap and small cap. The most famous mutual fund in this category is the Parag Parikh FlexiCap fund. Investing all your money into only one asset class is not wise. Apart from equities, debt is an asset class to consider. Debt funds give us fixed returns. In times of a stock market crash, debt instruments usually tend to perform well. Debt funds usually invest in government bonds, treasury bills, corporate bonds, etc. So in my opinion, some exposure to debt funds is absolutely necessary. Liquid funds is another option to consider for new investors. Suppose you want to save a large sum of money which you might need anytime in the near future. Inflation will reduce its worth because savings account interest rates are very low. So parking that money in a liquid fund will protect the money from inflation, and it can be withdrawn within 2 to 3 days. Before we talk about the risks of investing in mutual funds, let us understand the fact that most investors confuse volatility for risk. Even the advertisements emphasize that mutual fund investments are subject to market risks. Volatility and risk are two completely different things. Mr. Warren Buffett says that risk comes from not knowing what you are doing. So with the right knowledge, risk can be avoided. On the other hand, volatility in stock markets in the short term is unavoidable and investors must get used to it. There is nothing to worry about if your mutual fund portfolio corrects by 10% within a month, considering you have chosen the right funds. Now that was volatility. Now let's talk about risks. As per my understanding, there are two main risks of mutual fund investing. The first one is investing in the wrong fund. Now how to decide which fund is the wrong fund? For me, any mutual fund that consistently fails to generate better returns than the benchmark index is definitely a wrong fund. That's because investing in an index fund is much simpler and cheaper because its expense ratio is cheaper than that of a mutual fund. Let's have a look at this report by Standard & Poor regarding performance of mutual funds versus the benchmark index. The report found that up to 88% of actively managed funds in the large cap equity category fail to outperform the benchmark index. That means only 12% of mutual funds are worth investing into. Now, if you look into this graph carefully, you will notice that the percentage of mutual funds underperforming the benchmark index drops with increase in time horizon. So at a time horizon of 10 years, the percentage of mutual funds underperforming falls close to 60%. This takes us to the second risk, which is not staying invested for long enough. There was a very interesting study by Dalbar on mutual fund returns. This study found that the average mutual fund earned a return of 13.8% per year over the course of the study. But the average investor in those mutual funds earned just 7% per year. But how is that possible? Well, those investors took their money out when the mutual fund gave low return for a period of time, and they put their money back when the mutual fund gave high returns for a period. Here is a very recent article showing that 50% of investors in mutual funds take out their money within a year. This short-term investing and constantly chasing returns is the biggest risk for mutual fund investors. Now, what views do you have on mutual funds? Please share in the comment section. Thank you for watching the video, and I'll see you in the next one. Have a nice day.